Hey guys, this is Tyler. Today, we're going to talk about 5 ways that you are going to pay zero income taxes on capital gains legally. That's important. So we have to talk about what capital gains are and figure out all these types of different income taxes and different taxes that we pay. So the first one is thinking about, wages. Earned income from W-2 wages is taxed, one, at income tax rates, but you're taxed at FICA, FUTA, or Social Security and Medicare taxes. So those add in there, but that's not it. There's ordinary income, interest income that you receive, rents that you receive, royalties that you receive, or other income sources. There's also capital gains taxes, which we'll talk about in detail in this video. But beyond that, there's gas taxes every time you fill up the car. There's cell phone bill taxes every time you pay your cell phone bill. The average family pays over $300 a year just in cell phone taxes. It's absurd. Beyond that, there are property taxes on the property you own. There's sales taxes on the purchases that you make. And then, hey, if you're really generous and you give money to family or loved ones, you could be hit with gift taxes. And then finally, if that weren't all enough, you die, you could be subject to estate taxes. So why are income taxes or earned income probably the highest out of any of them? Well, it's because you're really paying taxes on 2 different items. Both you're paying income taxes and then you're paying Social Security and Medicare taxes called FICA, FUTA. So if you're an employee, the nice thing is your employer is going to pay 1/2 of those FICA, FUTA taxes. But if you're self-employed, you have to pay both sides. So here we go with an example. And I just pulled up, if you have a pretty good income at $100,000 a year and you're a W-2 employee, you're making a wage from a paycheck. So here we are, $100,000. And let's assume you're, again, married filing jointly here. So in 2023, you're going to have a standard deduction of $27,700, which is pretty nice. So in other words, you're going to pay taxes on the $72,300. At that tax rate, your ordinary income tax bill is going to be $8,236. But here's what we're talking about. Additionally, you're going to be subject to FICA taxes, which is 7.65% of that $100,000, which in this example is $7,650. So here we are, your total tax bill is $15,886. So how does that change if you're self-employed? Because there's no employer that's paying the other half, right? So let's look at the second example here where, again, the $100,000, let's flip to this screen. It's $100,000 of wages, but if you're self-employed, you get a deduction for 1/2 of the self-employment or FICA FUTA taxes that you pay. So here's the FICA FUTA taxes that we'll kind of skip to, but 1/2 of that actually goes up and reduces your $100,000 to $92,935. So again, you're still making $100,000 total, but you're only taxed as if you made $92 here because of that 1/2 of self-employment tax deduction. And again, these are using married filing jointly rates. Here's that standard deduction we talked about, $27,700 for 2023. And then your income tax, your ordinary tax, like here is $7,388, but FICA FUTA, you're paying 2 sides of it, right? So here's your FICA FUTA taxes this year on $100,000 of income, you're paying over $14,000. So your total tax bill is $21,000 versus close to $16,000 if you were a W-2 employee. So pretty fascinating when we start thinking about how you're employed, what those taxes are, because the nice thing about capital gains is you are not going to pay taxes at FICA FUTA rates. You're not going to pay taxes at ordinary income rates. Capital gains rates are in 3 brackets. So capital gains rates are either taxed at 0%. Pretty cool. They're taxed at 15%, or finally, they're taxed at 20%. So 0, 15, or 20 is how much those capital gains brackets are. So really the one we want to key in on is the 0%, because this video we're talking about how to pay 0. So let's look at it and start. This gets a little nerdy. If you're in the 12% income tax bracket, your capital gains bracket will be 0. So here we are, we ran numbers again, 2023. In a 12% income tax bracket, if you're in an individual, you can go up to $44,725. Or again, we're focusing mostly on married filing joint, you can go up to almost $90,000. But keep in mind, that's after that standard deduction of the $27,700 in 2023. So we're going to flip to that page, $27,700. So we're going to say rough math, 90 plus 28, that gets us to 118. So I'm going to round down here and say, let's say 117. So in other words, if your total income is less than $117,000, your capital gains bracket is, the good one, the donut, nothing. It's good. All right. So what does that look like? What are ways where we could make sure we're staying in that 0% long-term capital gains rate? So here we are with our first way to pay zero capital gains. The first way is keep your income low enough. By the way, this includes any realized capital gains. So if you realize 117,000, you'd be in the zero. But if you realize 118,000, you would kick yourself into the 15% tax bracket if you had no other income. But what are ways we can hold your income low? So the first thing, all right, if you have a good amount of cash on the sidelines, you don't have an income, you can just live off the cash in the bank and then potentially realize some capital gains at a 0% rate. You could also take a distribution if you're 59.5 out of your Roth IRA, as long as you've held that account for more than 5 years, that money from your Roth can come to you tax-free. You could sell an asset if you have a car or a boat or some kind of collection you could sell. But keep in mind here, if you're selling any collection at a gain, you might be subject to taxes on those gains. So really concentrate and focus on talking with an accountant to make sure you're not going to pay any taxes if you sell an asset. And then the last little thought about holding your income low is you could actually donate a significant amount to charity, and that would help offset some of your income and other assets. But keep in mind their donation rules. Generally, if you're donating cash, you can only deduct up to 1/2 of your AGI, your income. So if you made $100,000, you couldn't offset all $100,000. You'd only be able to offset $50,000 if you donated some money to charity. All right, so the second way that we can pay zero long-term capital gains rates is to actually just donate the capital gain property to charity, not to keep it yourself, but actually to donate it directly. So keep in mind, it's not sell and donate the proceeds, it's actually donate the security. So if you have a stock or a bond or a mutual fund or an ETF for, let's say, the last 5 years, it's gone up and down over time. And here today, you're sitting on a pretty meaningful capital gain. Let's call that capital gain. Let's say you invested $10,000 in this investment. And 5 years later, now today, it's worth $50,000. So there's a meaningful gain. Well, if you donated that property directly to a charity, either to a church or a hospital or school, or through a donor advised fund or some other mechanism, you actually don't pay taxes on the $40,000 of growth. And on top of that, you get a full $50,000 charitable deduction that gets to go on your Schedule A. So if we ran the math on it, and normally, let's say you're in a 15% tax bracket, so 0.15 times the $40,000. So here we are, that's $6,000 in potential tax savings by donating that property versus paying taxes at 15%. But oh, by the way, you also have a $50,000 charitable deduction, right? So let's say you're in a 32% bracket. There's another 16 grand if you've donated that money to charity. So here we save $6,000 in capital gains taxes, and we've also saved $16,000 not paying income taxes at a 32% rate because we got that charitable deduction. So there we are. We get $50,000 that goes to charity, and you save collectively $6,000 in capital gains, and then another $16,000 potentially if you're at a 32% income tax bracket. So total savings of $22 grand on $50,000 donation. That's a 44% savings in taxes by doing that. So pretty cool. Donate a property to charity, you pay zero capital gains. Oh, and by the way, you also get a charitable deduction. But again, be mindful if you're donating appreciated property, you're not limited to that 50% of AGI number. You're actually limited to 30% of AGI. So you'd have to have a higher AGI to deduct up to 50 grand in 1 year. All right, so there we are. The number 3 way that we can pay zero taxes on capital gains is if those investments were started in a Roth IRA, you wouldn't pay capital gains on any of it. In other words, if you had been funding a Roth IRA all these years, there are income limits, there are things to be mindful. You have to have earned income to be able to fund those Roth IRAs. But let's say you've had a Roth IRA for the last 15 years. You could take all of the gains from that as long as you're over 59.5, as long as you've held that account for over 5 years. At retirement, you can take all that money out tax-free. Let's talk about number 4. And number 4 is a big one because potentially you could sell capital loss property to offset capital gains. So here we are, if we're selling capital loss property, let's say you've accumulated a bunch of investments and some have done really well, some have done really poorly. Let's say you have collectively overall kind of a break even. Well, you could sell all of the gain property, sell all of the loss property, and you don't wind up paying any taxes on the gain property because you have enough losses over here that have accumulated. Keep in mind, talk to your tax professional around making sure that they're going to net, but generally capital gains and capital losses are going to net on a Schedule D. And they're offsetting one another, and you wind up paying potentially 0 in capital gains on those gains because you've realized losses somewhere else. The other little thing to keep in mind, if you sell at a capital loss, you have to be out of that position for more than 30 days. You can buy a similar security, but you can't just sell and purchase the same security right back if you want to own it long term just to realize those tax benefits of having a capital loss. All right, the last one. Congratulations, the 5th way to pay 0 taxes on capital gains is to die. Yeah, I said it, to die. I don't recommend dying for a tax savings, but yeah, you could die. In other words, in most states, you wind up getting a full step up in basis or a partial step up in basis, depending on how the assets are titled and held. But if you own the property by yourself, generally you're going to get a full step up in basis at death. That means, hey, you bought a security for $10,000 today, it's worth $50,000, you die. Again, somebody inherits that. They're not going to pay capital gains on the $40,000 of growth. They could, again, pay estate taxes depending on the size of your estate, but I certainly do not recommend dying for the sake of saving some taxes. The trade-off just doesn't work. So there we are. That was 5, I think, right? Was that 5? I think we got it. Cool. Thanks for watching. We'll do this again soon. Hey, if you watched up to this point, you should definitely subscribe. You should definitely like and check us out again. Thanks for watching.